Welcome to this special meeting today, okay? Yes, our foreign investor, Mr. Malhotra, and all the divisional managers. I am the CEO of our company. I'm Chamali Devamini, and we have arranged this special meeting for discuss and give a brief explanation to Mr. Malhotra, who is the newest investor from India today. Here, Mr. Malhotra joined with us via Zoom, so I want to mention it that for you. And let's continue our discussion. We are Abans PLC, the parent company of the Abans Group. We have acquired a few companies. Those are AB Manufacturing Private Limited, SA Electricals Private Limited, AP Sun City Private Limited, and Abans Finance PLC. Those are the subsidiary companies within our group. Okay, so under the group financial statement, we can identify several types of consolidation adjustments. So we have to explain about that. So in our Mr. Malhotra in our conversation. So Mr. Malhotra, you can, if you have any doubt, you can clarify with us. So our team members, our divisional managers are also there. So you can ask any question with our discussion. So let's continue. So Mr. Malhotra, do you have any explanation and do you have anything to say?
Thank you, Chamudi. Good morning, everyone. I am one of the main investors of the Hades group also. These days, I am looking for investing in the Abbas group. So before that, I would like to clearly do adjustment in consolidated statement which the most important to take my decision.
Okay, Mr. Malhotra. Before joining to the adjustment, let's take an overall idea. A parent company is an entity that owns the voting shares in another company to control its management and operations. The control usually comes from holding more than 50% of subsidiaries' voting stock. A subsidiary is a company that controlled by a parent company, though majority ownership. Let's take an example. Our Abans PLC is a parent company and our subsidiaries are AB Manufacturing Private Limited, SA Electricals Private Limited, AB Sun City Private Limited, and Abans Finance PLC. A control company refers to the parent company's power to direct and relevant activities, financial and operating policies of the subsidiary. Let's take a previous example. Though it's 50% ownership of Abans Finance PLC, the PLC exercised control to the over its operations. NCI means non-controlling interest. NCI represents the portion of subsidiary is not owned by the parent company. Subsidiary shareholders in minority portion have an interest the subsidiary's net asset but don't influence control.
Oh yes, Ms. Malhotra. Our Aban PLC, we are a well-known company in Sri Lanka. Also operates through subsidiary. Intergroup transactions are common in such a structure. Accordingly, there are many examples for intergroup transactions that the Aban PLC we have selected have fixed, such as selling and buying goods, providing service, a loan and advance, dividend and interest, etc. Accordingly, our Aban PLC sells product to its subsidiary Abans Electric PLC for resale the consumer. On the other hand, our Aban PLC also purchase goods for its subsidiaries Abans Holding PLC. Then we can do a combined treatment for this to avoid double counting of income and expense. We need to eliminate intercompany sales and purchase. Similarly, inventory valuation is also needed to reflect the cost of goods sold external customers. It is also the case that Abans PLC provides administrative and financial service to its subsidiary. Similarly, our Aban PLC also leases properties to its subsidiary. Accordingly, intercompany service fees has been eliminated from the financial statement of our Aban PLC. Similarly, our Abans PLC has also made loans and borrow from its subsidiaries etc. Accordingly, the amount of debt payable has been adjusted after removing interest expenses and interest income for the financial statement of our urban PLC. Also, our urban PLC can receive dividend from its subsidiary and pay interest on loan to subsidiaries. Accordingly, intercompany dividends and interest income has been eliminated from the financial statement of our urban PLC.
I think Mr. Malhotra also should need to know about the consolidation profit of our company. So, Ms. Saini, can you explain about that profit?
Of course, madam. If we think about a standalone company, one company can sell their goods with the profit to another company, third party. We can identify that profit as realized profit. But when it comes to group companies, if holding company sell goods with the profit to its subsidiary company, we can't identify that profit as realized profit. We call it as unrealized profit because we have to treat the companies that in group accounts as a one unit, as a group. So we treat it, we call it that profit as unrealized profit. Basically, we can see unrealized profit in group accounts in two things. They are inventories and property plant equipments.
I need to know if group sell goods to another company, then what happened to profit?
Yes, Ms. Malhotra. If subsidiary company sell its goods to another company, that means a company out of the group, the third party, they can't treat that profit as unrealized profit because that stocks are not in the group. They are not existing in the group further.
Okay, Mr. Malhotra, now I explain about the NCI part. NCI is a shareholders' equity interest in a subsidiary the parent's company does not own. Parent company means our company, Avans PLC. It arises when the parent company owns less than 100% of subsidiaries. IFRS 10 is the accounting standards related to this adjustment. To calculate non-controlling interest, first of all, we should determine the ownership percentages. Abans PLC owns 50% of shares in Abans Finance PLC. According to this example, NCI ownership is the rest of part. To calculate non-controlling interest in net income, you can see the percentage, the formula. NCI in net income equal subsidiaries net income multiplied by NCI ownership percentage. This amount is deducted from consolidated net income to attribute profit to the NCI shareholders. And also to calculate net non-controlling income in subsidiaries net assets, you can see the formula in the presentation. NCI in equity equals subsidiaries net assets end of the period multiplied by NCI ownership percentage. Net assets include the total assets minus liabilities.
Can you explain that part with a small example?
Okay, Mr. Malhotra, as mentioned in the presentation, we can calculate NCI part, and also NCI is shown as the separate line item with the equity in the consolidated balance sheet, and also NCI's share of the net income is deducted to arrive at the parent company's share of net income in consolidated income statement.
Okay, Sandhani, in the context of the Abans PLC, adjustment for the dividend in the consolidated financial statement primarily ensure that the group financial accurately reflect the overall economic reality of the group. If the Abans holding Abans electrical pay the dividend to the Abans company, these dividends must be eliminated during the consolidation. Because the dividend is an intergroup transaction, dividend paid to the non-controlling shareholder of the Abans Holding, Abans Electrical are the not eliminated because these are the external to the group. Presentation in the financial position, dividend payable to the external parties are the show as a liability if declared before the reporting date. Consolidated statement of change in the equity, dividend paid to the deduct from the retained earning or non-controlling interest so appropriate. As well as consolidated income statement, intergroup dividend received by the Abans company from the Abans Holding, Abans Electrical are eliminated from the consolidated income statement.
As an investor, I mostly consider about the goodwill of the company. How about goodwill adjustment in consolidated process?
Goodwill is the extra amount company pays when buying another company. Value the its net asset to calculate. We use the formula goodwill equals the amount paid minus the fair value of the asset acquired. It's like paying more business because its reputation, customer relationship, or future earning potential. Goodwill is treated as an intangible asset in the finance statement when the parent company buys subsidiary, it combine asset, liability, and equity into one. We can see example. The calculate the goodwill involves following components and investment of 500, non-controlling asset 100, and net asset value of minus 50. Together these total goodwill value of 550 after accounts for an impairment loss of 50. The real goodwill is determined to be 500.
Yes, let's now talk about what is pre-acquisition and post-acquisition profits. Pre-acquisition profits earned before the acquiring company took over the business. These profits before to the previous shareholders. Post-acquisition profits earned after the acquiring company took over the business. These profits belong to the acquiring company. Abbas Finance PLC operating as a subsidiary company of the Abbas Group. Abbas Group is a post-acquisition company. It was identified from the financial statement that it was a post-acquisition profits. That is, net profits after tax for the financial year 23-24 is 104.033 million. Net profit after the tax for the financial year 22-23 is 355.06 million.
Thank you all for your participation in today's special meeting. Especially I grateful to thanks Mr. Malhotra for your decision to invest our company. We are performing well and your invest will definitely save with us. So we think according to our discussion, we discussed about a few consolidation adjustments like goodwill, post and pre-acquisition, non-controlling interest, like that. So Mr. Malhotra, Abbas PLC will be the best choice for you to invest, and now we think you could able to get a understanding about for consolidation accounting.
Okay, now we all came into the end of our today's discussion. So, Mr. Malhotra, I think you could able to get enough information about today's session. So, thank you all for your coming for this discussion. So, have a good day.